Welcome to the deep dive.
Great to be diving in.
Our mission, as always, is to take a stack of information articles, reports, notes, you name it, and really unpack it.
Yeah, pull out the key insights, the surprising bits, maybe connections you'd miss just scanning headlines.
It's about getting you informed, properly, efficiently, understanding the so what behind the news.
Exactly.
And today, we've got a pile of sources covering India's finance, banking, the economy, all from May 2025.
A really busy month. We're seeing new market instruments, regulatory tweaks, economic data, sector updates.
Right, everything from agriculture to infrastructure. We're going to try and cut through the noise, give you those key takeaways, and explain why it matters to you.
Let's get into it.
All right, let's unpack this. And I think the financial markets feel like the right place to start. Lots happening there in May.
Absolutely. A really big one, a milestone actually, happened on May 5th.
Oh, yeah.
India's first ever mortgage-backed pass-through certificates, PTCs, were listed on the National Stock Exchange.
Okay, PTCs. Now, for listeners who maybe track the markets but aren't deep into these specific instruments, what are they exactly, and why is this listing such a big deal?
Think of them like investment certificates. They basically represent a slice of a pool of home loans.
Okay.
In this particular case, the loans backing it are from LIC Housing Finance. So homeowners make their mortgage payments.
And that cash flow passes through.
It passes through to the investors holding these certificates. That's the pass-through part.
Got it. And who put this structure together? The RMBS Development Company?
Yes, RDCL.
Yeah.
It was specifically set up by the National Housing Bank, the statutory body.
Right.
Their whole goal is to sort of kickstart and nurture this market for residential mortgage-backed securities in India.
To make it easier to package and sell these loans?
Pretty much. Create standardized products like these PTCs that can attract long-term institutional money. Think pension funds, insurance companies.
And this first issue was sizable, 1,000 crore. So what does having these listed actually mean for the housing finance sector overall?
That's really the core significance here. It creates a direct pipe, a link, between the housing finance market, these pools of home loans, and the broader debt capital markets.
Okay.
It gives housing finance companies a new route to raise funds. They can sell off existing loans packaged like this.
Frees up their balance sheets.
Exactly. Frees up capital so they can then originate more new loans.
Yeah.
The hope is this boosts housing finance availability, maybe supports more housing and infrastructure projects down the line.
Mm-hmm.
It's about efficiency and attracting bigger pools of capital.
More money flowing into housing, into infrastructure. That sounds pretty fundamental.
It is.
And speaking of new instruments, new rules, SEBI, the market regulator, also rolled out updates for securitized debt instruments, SDIs. What are these and what changed?
SDIs are, similar in concept. Pooling debt could be loans, mortgages, even things like trade receivables, and then slicing it up into securities to sell.
Right, the goal being liquidity, spreading risk.
Mm-hmm. Yes, converting illiquid assets into something tradable. SEBI's changes were really focused on standardizing things more and beefing up investor protection.
Like, I saw they set a minimum investment size.
They did. A floor of 1 crore for most issuances and transfers.
So not really for small retail investors.
No, definitely aimed at the institutional market, high net worth individuals. They also mandated DMAT form.
Everything electronic, no paper certificates.
Right. All issuance and transfer has to be in dematerialized form now. Better tracking, better security, less paperwork.
Well, what about the originators? The ones creating these SDIs? Any new requirements for them?
Yeah, a couple of important ones. They now need a minimum track record, 3 years of operating experience.
Okay.
And critically, they have to retain some risk, usually at least 10% of the value, sometimes 5% if the underlying loans are very short term.
Ah, the skin in the game rule.
Exactly that. It aligns their interests with the investors. They can't just originate loans, package them, sell them off, and wash their hands of the risk if the quality isn't there.
Makes sense. Prevents a race to the bottom on loan quality, potentially.
That's the idea. SEBI seems to be really pushing for, more structure, more transparency across these kinds of pooled debt products.
And that theme carried through with changes to the EBP mechanism too, right? The electronic book provider platform for private debt.
Yes, another move towards transparency. They lowered the threshold quite a bit.
Down from 50 crore to
20 crore rupees.
Yeah.
So any private placement of debt securities or things like non-convertible preference shares, even municipal bonds, above 20 crore now has to go through this electronic bidding system.
So a much bigger chunk of the corporate bond market now needs to use this platform.
A much bigger chunk. The goal is pretty clear. Better price discovery, more efficiency, just more openness in how companies raise debt privately. It's a huge funding source, so making it more transparent is important.
Okay, and then there was movement on ODI's offshore derivative instruments, sometimes called P-notes. SEBI extended a deadline.
They did. Push back the compliance date for some new, more granular disclosure requirements for certain ODI subscribers. It's now November 2025.
Who needs to provide this extra detail?
It applies mainly to subscribers who have pretty significant positions, either heavily concentrated in one Indian company group or just very large total equity holdings in India over 25,000 crore.
And the reason for demanding this extra detail?
It's part of SEBI's ongoing effort to align the rules for ODIs more closely with the rules for registered foreign portfolio investors, FPIs.
Closing loopholes, preventing regulatory arbitrage.
That seemed to be the driving force. They also tightened rules around FPIs using derivatives in conjunction with ODIs, again, likely to prevent complex structures that might obscure the ultimate beneficial owner or risk profile.
Okay, let's pivot to the F&O market. Futures and options. Big area, lots of changes announced there for risk monitoring, position limits, phased in over the coming months. What's the overall goal here?
The big picture. It seems to be about strengthening risk controls, reducing volatility, and trying to minimize the potential for manipulation or excessive concentration, especially in index options, which have seen explosive growth.
Right, and maybe cut down on how often stocks hit those F&O ban limits?
That could be a consequence, yes.
Yeah.
Making the market generally more robust.
One specific change I noticed was how open interest is calculated. Moving to future equivalent OI based on delta, how does that work?
This is a really key technical shift. Traditionally, open interest is just the number of outstanding contracts. Simple count.
Okay.
Future equivalent OI, which uses the options delta, its sensitivity to the underlying price gives a much better sense of the actual market risk exposure those contracts represent.
So it's not just how many contracts, but how much market impact they could have.
Exactly. It's a more sophisticated risk-weighted view, especially important for options where the risk isn't linear like futures. Exchanges can now monitor leverage and concentration risk more effectively using this measure.
The more accurate risk picture. And they're adjusting position limits based on this too.
Yes, market-wide limits and individual limits are being recalibrated using this few EI, and also linked to things like average daily delivery value. Again, the goal is preventing any single entity or group from building up excessive, potentially destabilizing positions.
And I saw something about allowing risk reduction trades even if a stock is in the F&O ban, period.
Yeah, that's a practical adjustment. Normally, when a stock hits the ban list, you can't increase your open positions.
Right, you can only square off.
But starting in October, if you have an existing position and you can make a trade that reduces your overall delta exposure, essentially lowers your directional risk,
Yeah.
you might be allowed to execute that trade even during the ban.
So it gives traders a way to actively manage down their risk, not just exit entirely.
Precisely. A bit more flexibility for risk management in those restricted situations.
Sounds like a pretty thorough overhaul of F&O risk management.
It really is. It touches calculation methods. Monitoring frequency clearing corporations will do multiple intraday checks. Now limits for different categories of investors, even rules for which indices can have derivatives. It signals a strong regulatory focus on containing potential systemic risks from leveraged derivatives trading.
Okay. Shifting focus slightly again. We saw the Venture Capital Association, IVCA, urging older VCFs, venture capital funds, to migrate to the newer AIF regime. Why was that happening?
This follows a framework SEBI put out last year. It basically allows these older VCFs, registered under previous regulations, to transition smoothly into a specific category under the current Alternative Investment Fund, or AIF rules.
To bring them into the modern framework.
Essentially, yes. It gives them a clearer regulatory pathway, simplifies compliance, potentially offers some fee waivers. It's about getting these legacy funds, especially those still managing investments, onto the current regulatory platform.
And speaking of AIFs, Category 2 funds got a bit more leeway in May.
They did. CATSB AIFs think private equity, private debt funds primarily invest in unlisted companies.
Right.
SEBI tweaked the rules to allow them also to invest in listed debt securities, including those SDIs we talked about earlier, even if they have a credit rating of A or lower.
So a bit more flexibility beyond just unlisted stuff?
Yeah, just adds another potential asset class for their portfolios, though the primary focus on unlisted remains. Gives managers a bit more scope.
Okay, let's just take a step back here. We've covered new instruments like PTCs, detailed rules for SDIs, EBP, ODIs, a major overhaul of F&O risk management, shifts in the VC and AIF space. How does all this knit together? What does it mean for the overall financial market environment that, people interact with?
It paints a picture of, I think, continuous refinement and regulation. There's a clear push towards more transparency. You see that with EBP, the SDI rules, the ODI disclosures. There's a focus on better risk measurement and control, so especially in derivatives.
And standardizing.
And standardization, yes, with instruments like PDCs and SDIs, hoping to attract broader, perhaps more institutional investment. For someone engaging with the market, whether as an investor or using financial services, it points towards a system that's becoming more formalized, more heavily regulated.
Aiming for more stability and efficiency.
That's the goal. More stability, greater efficiency, but also maybe more complexity with these newer instruments. The move to digital formats, clearer rules, it's ultimately meant to build trust and hopefully reduce risks and surprises for everyone involved.
A balancing act, it seems, keeping pace with innovation while strengthening the foundation.
Exactly. And that same theme of stability, regulation, and adaptation carries over when we look at the banking system and the RBI's actions in May.
Definitely. A huge headline there was the record profit from the public sector banks, the PSBs, 1.78 lakh crore in FY25.
That's a massive number, up 26% from the previous year. And SBI alone contributed, what, over 40% of that profit?
Yeah, around 70,000 crore just from SBI. It's a dramatic turnaround from just a few years ago when many were reporting losses.
A huge turnaround.
What really drove that recovery?
Well, it's generally attributed to sustained government efforts over several years. The 4R strategy they talked about, recognizing bad loans, resolution and recovery, recapitalizing the banks with significant fund infusions, and reforms in governance.
So cleaning up the balance sheets and putting in capital.
Fundamentally, yes. That led to lower non-performing assets, NPAs, improved lending practices, and ultimately much healthier profitability.
So healthier PSBs point to a more stable banking system overall.
Generally, yes. Their health is a major indicator of the system's overall stability and capacity to lend.
The RBI also seemed keen on getting a better feel for the economy, launching new surveys.
They did. 3 important ones for their policy input. One focused specifically on household inflation expectations across 19 cities.
What people think inflation will be.
Exactly. Subjective assessments. Then there's the regular urban consumer confidence survey, but they also launched a new rural consumer confidence survey.
Covering rural and semi-urban areas, why the split and why now?
Well, the RBI uses a lot of hard data production, sales, inflation numbers. But these surveys give them the qualitative side, the sentiment. How are households actually feeling about prices, jobs, their income, their spending plans?
The mood on the ground.
Precisely. And separating urban and rural acknowledges that experiences and outlooks can differ significantly between those areas. This sentiment data is crucial context for monetary policy decisions. It helps them understand how people might react to economic changes or policy moves.
Adds that human layer to the spreadsheets. Makes sense.
Mm-hmm.
And sticking with the RDI, they eased some rules for foreign portfolio investors, FPIs, investing in corporate bonds.
They did. They removed some specific caps that limited how much FPIs could invest in corporate bonds with less than 1 year maturity. They also simplified some concentration limits for individual FPIs.
The goal being?
Pretty straightforward. Make it easier, more appealing for foreign money to flow into Indian corporate debt. This helps companies diversify their funding sources and potentially lowers their borrowing costs.
And then FIMDIA was recognized as the first SRO under the RBI's new framework. What's FIMDI and what does being an SRO mean?
The FIMDI, the Fixed Income Money Market and Derivatives Association, is already a major industry body. Think banks, financial institutions dealing in bonds, money markets, derivatives.
Okay.
The RBI recognizing them as a self-regulatory organization, an SRO under this new 2024 framework, gives them a more formal role. It's essentially the RBI delegating some oversight and standard-setting responsibilities for that specific market segment to the industry body itself.
So the industry polices itself more under RBI's watch.
That's the principle. It aims to leverage FIMDI's market expertise for better day-to-day governance, setting ethical standards, handling minor disputes, and promoting market development, while the RBI retains overall regulatory control.
Interesting delegation. Now, we absolutely have to talk about the RBI's dividend payout to the government. Record high, right? 2.69 lakh crore.
An absolutely massive transfer, the highest ever surplus payout.
What drove such a huge surplus for the RBI?
A combination of factors. They had strong earnings from managing foreign exchange reserves, including profits from selling dollars, higher interest income from both foreign and domestic assets they hold, and significantly, mark-to-market gains on their government securities portfolio as bond yields fell.
And even with that huge payout, they still increased their own safety buffer?
Yes, they raised their contingency risk buffer, the CRB, from 6.5% to 7.5% of their balance sheet, so they strengthened their own resilience while making that record transfer.
What's the likely impact of this windfall for the government's finances?
It's a significant boost. It helps plug the fiscal deficit, gives the government more breathing room. It could mean less pressure to borrow, potentially helping keep interest rates stable. It might allow them to maintain capital expenditure plans or even offer some targeted fiscal support elsewhere. It also injects liquidity into the banking system, though the RBI manages the overall impact of that through its operations.
A helpful cushion, then. Another big structural move was the formal notification of the Payments Regulatory Board, the PRB.
Right, this replaces the previous board that supervised payment systems. It's a new 6-member body set up under the Payments and Settlement Systems Act.
Chaired by the RBI governor, but with government nominees, too.
Yes, 3 RBI officials, including the governor and deputy governor in charge of payments, plus 3 nominees from the central government.
What's the rationale for this new board?
It really strengthens the focus and dedicated oversight on India's payment systems landscape, which has just exploded with digital payments, UPI, wallets, and everything else. It ensures high-level attention and coordination between the RBI and the government on regulating this critical infrastructure.
And speaking of digital payments, we saw some fintech action, too. Zigzook got an approval.
Yes, an in-principle nod from the RBI to issue prepaid payment instruments, think of wallets and prepaid cards, and also act as a third-party app provider for UPI payments. Shows new players are still entering that competitive space.
And NPCI, which runs UPI, brought in a new rule about displaying names.
A very practical one, effective June 30th. UPI apps now must display only the bank-registered name of the recipient for peer-to-peer or peer-to-merchant payments.
Why the change?
Fraud reduction, mainly. There were cases where fraudsters used misleading display names to trick people into sending money. By showing the official name linked to the bank account, it makes it much harder to impersonate someone or create confusion. It's about building user trust and cutting down disputes.
A simple change, but potentially impactful for security.
Definitely. And on the security front, the Department of Telecom, DOT, launched something called the Financial Fraud Risk Indicator, FRI.
Telecom department getting involved in financial fraud, how does that work?
It's a risk-based tool. It uses data from various sources, cybercrime portals, bank reports, the Chakshu platform for reporting suspicious communications, to analyze mobile numbers and categorize them based on their association with financial fraud. Medium risk, high risk, very high risk.
So flagging risky phone numbers.
In near real time. The idea is that banks and other financial entities could potentially use this feed to get an alert if a transaction involves a number that's been flagged as potentially fraudulent. It's about using telecom data intelligence to add another layer of defense against digital financial crime.
Interesting synergy there. Okay, so thinking about this whole banking and payments section, record PSB profits, RBI surveys and rule tweaks, the huge dividend, new payment board, fintech moves, and these anti-fraud measures, what's the takeaway for the average person interacting with the system? How does it affect the stability and trustworthiness they rely on?
I think it suggests a system that's, on the one hand, financially stronger, judging by the bank profits. On the other hand, it's actively adapting. The RBI is using more tools, both quantitative and qualitative, to navigate the economy and manage flows. And critically, there's a very visible, multi-agency effort to tackle the risks that come with digitization, particularly fraud in payments.
So trying to keep the foundation strong while making digital interaction safer.
That seems to be the direction. Proactive strengthening, proactive risk management. It aims to bolster the overall stability and trustworthiness you need when you bank, pay, or invest.
Right, building that confidence is key. Okay, let's broaden the lens now to the overall economic picture for India. Growth, trade, readings, what did May tell us?
Well, a definite positive was the credit rating upgrade from Morningstar DBRS. They lifted India's long-term foreign and local currency ratings to BBB with a stable trend.
Up from BBB low, what reasons did they give for the upgrade?
They pointed to a few key things. Ongoing structural reforms, especially in infra and digitalization. They noted the government's efforts towards fiscal consolidation, managing the budget deficit, and just overall macroeconomic stability.
And the strong growth numbers probably helped.
Absolutely. They highlighted the resilient average GDP growth in recent years, around 8.2% from FY22 to FY25. They also mentioned controlled inflation, a stable rupee, a healthy external position, and importantly, that resilient banking sector with NPAs at a 13-year low.
So a thumbs up on the general direction.
Pretty much a vote of confidence, yeah. They did note the high overall government debt, but also that its structural long maturity, mostly local currency, reduces immediate risks.
Looking at the latest indicators for May, retail inflation for April came in surprisingly low, didn't it?
It did. 3.16%. That's the lowest since mid-2019, I believe. And the third month in a row, it's been below the RBI's 4% target.
What drove it down?
Food inflation was particularly low, just 1.78%, the lowest in quite a while. Seems good harvests help keep prices in check, even with some reports of heat waves. This lower inflation certainly gives the RBI more flexibility on interest rates down the road.
But on the flip side, industrial production, IP growth, slowed down in April.
It did slow to 2.7%, an 8-month low. Mining and electricity output were weak points. Manufacturing held up a bit better, and capital goods growth was actually very strong, suggesting investment is happening.
But consumer goods.
Consumer non-durables contracted. That points towards maybe patchy or uneven consumer demand, which is something economists will be watching closely.
And the final GDP numbers for the full fiscal year, FY25.
Came in at 6.5% growth for the year. That's a bit lower than the year before, but the last quarter, Q4, finished strong at 7.4% growth. Manufacturing and construction were solid performers for the full year, and household consumption growth was also healthy at 7.2%.
We see various agencies putting out forecasts for FY26, generally clustering around, 6.2 to 6.5%?
That seems to be the consensus range, yeah. Agencies like the IMF, UN, S&P, Fitch, they all see continued robust growth, maybe moderating slightly, but still strong compared to global peers.
And many are projecting India climbing the global economic ranks.
That's a recurring theme. The IMF thinks India could become the world's fourth largest economy in FY26, overtaking Japan. S&P Global projects India hitting the number 3 spot by 2031. These projections are based on sustained growth, favorable demographics, and ongoing reforms.
How did India's trade performance look in the latest data?
The trade deficit widened a bit in April. But looking at the full fiscal year FY25, total exports actually hit a record high, $824.9 billion, up 6% year-on-year.
Merchandise and services.
Both contributing. Merchandise exports were strong in April itself, but the real star continues to be services exports. Grew 17% in April, leading to a very healthy services trade surplus. That surplus is crucial for balancing India's overall external account.
Okay. Now, FDI trends were a bit mixed, weren't they? High gross inflows, but very low net inflows.
Yes, that's a really interesting point from the FY25 data. Gross FDI, the total amount of foreign direct investment coming in, hit a 3-year high of $81 billion. That shows foreign companies are still investing, maybe driven by acquisitions, market expansion, government schemes like PLI.
But the net figure?
The net FDI, which subtracts outflows like repatriation of profits by foreign firms or Indian companies investing abroad, slumped massively, down over 96% to just $353 million for the full year.
Wow, so almost as much money flowed out as came in on a net basis.
That's what the net figure implies for FY25. It's a sharp contrast to the gross number and continues a trend of declining net FDI that's been observed since the pandemic. Analysts are watching this closely, trying to understand the drivers behind these increased outflows.
One potential external factor affecting inflows, or at least remittances, is that proposed U.S. tax.
Right. The bill in the U.S. proposing a 5% excise tax on international money transfers by non-citizens.
How could that impact India?
Well, the Indian diaspora in the U.S. is large, around 2.3 million people, and they sent back something like $23 billion in 2023. If this 5% tax is levied on those remittances, it could significantly reduce the net amount received in India. Critics also argue it unfairly targets legal immigrants and might push some funds into informal channels. It's something to watch.
Okay, pulling these economic threads together, the rating upgrade, the growth figures, inflation dipping, strong exports but tricky net FDI, and this potential remittance tax, how does this paint the picture of India's economic momentum? What are the key things you should maybe watch out for?
The overall picture remains one of resilient domestic strength. Growth is solid. Inflation seems manageable for now. The external balance is supported by services exports, leading to that rating upgrade.
But there are watch.
Definitely. Key things to watch are global headwinds, slowdowns, or protectionism affecting exports. How domestic consumption holds up, especially if inflation ticks back up. The trajectory of net FDI, why are outflows increasing? And, of course, the government's ability to stick to its fiscal consolidation path while still driving investment. It's a picture of good momentum facing some known and potential headwinds.
A useful summary. Let's drill down now into some specific sectors: infrastructure, energy, agriculture. Lots of policy action and developments here.
Absolutely. Starting with infrastructure, a major event was the dedication of the Vizhinjam port.
Right, down in Kerala. Why is this particular port considered so significant?
It's being positioned as a major transshipment hub for the entire region, not just India. It's deep water, all-weather, and strategically located on major shipping routes,
Transshipment meaning?
where large mother vessels unload cargo, which is then transferred to smaller feeder vessels for distribution to other ports. Currently, a huge chunk of India-bound cargo, maybe 75%, gets transshipped at foreign ports like Colombo, Singapore, or Dubai.
So Vizhinjam aims to capture that traffic on Indian soil.
Exactly. The goal is to reduce India's reliance on foreign ports, which adds cost and time. Bringing that business to Vizhinjam could save hundreds of millions of dollars annually in logistics costs and make Indian trade more efficient. It uses advanced tech, like AI-driven vessel tracking, too.
A potential game changer for maritime trade, then.
That's the hope. And alongside coastal shipping, there's a continued push for inland waterways, like that MOU signed between IWAI and Rhenus Logistics.
Yeah, tell us about that.
This is really about bringing in more private sector players to operate barge services on India's rivers and canals, the national waterways. Rhenus plans to deploy a significant fleet, like 100 vessels, over time.
Why the push for water transport?
It's generally seen as more fuel efficient and environmentally friendly than road or rail for bulk cargo over long distances. The government is investing heavily in developing waterway infrastructure dredging, terminals under projects like Jal Marg Vikas, supported by the World Bank.
So it's about creating a cheaper, greener logistics alternative.
Precisely. Building a truly multimodal system where cargo can shift seamlessly between road, rail, and water, lowering overall logistics costs, which are still quite high in India, and making transport more competitive.
Okay, shifting to energy. The growth in renewable capacity over the last decade has been phenomenal.
Truly staggering numbers. Total renewable capacity, including large hydro, tripled from around 76 GW in 2014 to over 230 GW now.
And solar is the big driver.
Solar has exploded, from less than 3 GW to over 100 GW. Wind power has more than doubled too. India is now genuinely a global leader in deploying renewables.
And crucially, the domestic manufacturing capacity for solar panels has also ramped up.
Yes, that's been a major policy focus. Building domestic manufacturing capacity for modules, cells, even wafers. The capacity for modules went from almost nothing to around 90 GW. This supports the energy transition, creates jobs, and reduces import dependence.
Plus schemes to encourage rooftop solar.
Right, the PM Surya Ghar scheme has seen significant uptake, bringing solar directly to homes. India added a record amount of renewable capacity just in 2024 alone, aiming for that huge 500 GW target by 2030.
While renewables surge, conventional power isn't being ignored. The government revised the Sheikh ITI policy for coal allocation.
Yes, this is about ensuring coal supply for thermal power plants, TPPs. The revised policy aims for more flexibility and transparency.
How so?
It introduces two main windows for getting coal linkages. Window I provides coal at notified prices, mainly for government-owned or joint venture plants. Window 2 uses an auction mechanism where any power producer, even private ones without long-term power purchase agreements, PPAs, can bid for coal, paying a premium over the notified price.
So an auction route for private players.
Yes, up to 25 years. The idea is to provide more certainty of fuel supply, encourage new private investment in thermal capacity, especially efficient plants perhaps located near coal mines, pitheads, to cut transport costs. It also aims to help plants designed for imported coal switch to domestic coal, saving foreign exchange.
More flexibility, aiming for efficiency, and lower costs eventually for consumers.
That's the objective. Better utilization of domestic coal resources, more competition, potentially leading to more stable power supply and tariffs.
Okay, now let's move to agriculture and related areas. The policy of using Food Corporation of India, FCI, rice for ethanol production continued.
Yes. The government approved an additional allocation of FCI rice, bringing the total planned usage for the 2024-25 ethanol supply year to over 5 million tons.
This supports the ethanol blended petrol program.
Correct. The EBP program aims to reduce reliance on imported crude oil, cut pollution, and provide an additional revenue stream for the sugar industry and farmers. Distilleries get this rice at a subsidized rate.
But this diversion of food grains for fuel isn't without controversy, is it?
No, it's definitely a point of debate. While it serves energy security goals, concerns are consistently raised about using edible food grains like rice and maize for first-generation biofuels, especially in the context of overall food security. There's a parallel push for second-generation ethanol from agricultural waste, which is seen as more sustainable. It's a complex balancing act.
We also saw record production figures from the mining sector in FY25.
Yes, strong growth across several key minerals. Iron ore production hit a record high, reflecting robust demand from the steel industry. Manganese, bauxite, lead also grew.
And non-ferrous metals?
Record primary aluminum production and strong growth in refined copper. India ranks highly globally in producing these metals. This basically mirrors the demand coming from infrastructure development, construction, manufacturing, automotive, and energy sectors. It's a sign of strong industrial activity.
And on the food distribution side, the PDS, the public distribution system, saw more digital initiatives launched.
All right, 3 key ones. Depot Darpan, a portal for FCI depots using IoT and CCTV for better management, and Amitra, a mobile app for beneficiaries providing real-time data, and ASSSSE, a grievance redressal system using WhatsApp and IVRS.
Aimed at the 81 crore people covered under food security schemes.
Exactly. The goal is enhancing transparency, accountability, and efficiency in delivering subsidized food grains, reducing leakages, empowering beneficiaries with information, and easier ways to report problems. It involves upgrading warehouses with smart tech too. It's a major digital push for this crucial social safety net.
Okay, let's get into some very specific agriculture announcements. ICAR launching India's first genome-edited rice varieties. That sounds significant.
It really is.
Yeah.
This is using advanced gene editing techniques, not traditional GMO methods, to develop new rice varieties.
Like DRR Dun 100 Kamala and Pusa DST Rice 1, what are their benefits?
They offer things like earlier maturity, potentially much higher yields, reduced need for water and minerals, heat tolerance, suitability for direct seeding instead of transplanting, and salinity tolerance.
So addressing multiple challenges at once: climate resilience, resource efficiency, farmer income.
Precisely. This kind of targeted breeding using modern science could be a major boost for food security and making agriculture more sustainable and profitable in the face of climate change. A big step.
And on the pricing front, the fair and remunerative price, FRP, for sugarcane was increased for the next season.
Yes, up to 355 per quintal for the standard recovery rate, an increase from 340. This is the legally guaranteed price sugar mills must pay farmers. The government stated this provides a very high profit margin over the estimated cost of production.
And they also brought in rules for sugar mills and Kansari units.
Mandated digital reporting for sugar mills for better transparency. And importantly, regulated larger Kansari units, traditional sugar producers, for the first time, requiring them to pay FRP, and included raw sugar under the definition to prevent mills avoiding payments.
Ensuring farmers get paid fairly across the board.
That's the aim. Alongside this, the Modified Interest Subvention Scheme, MISS, for farmer credit was continued.
This is the scheme for cheap loans via Kizan credit cards, KCCs.
Exactly. Ensures farmers get short-term loans up to $3 lakh at a highly subsidized interest rate, effectively 4% per annum after government subvention. It's crucial for millions of farmers to afford inputs for planting, a major pillar of agricultural finance and inclusion.
And the government launched a new campaign, Viksit Krishi Sankalp Abhiyan.
Yes, aimed at transforming agriculture. It involves direct interaction between farmers and agricultural scientists across thousands of locations, providing advice, promoting modern techniques, and linking farmers to schemes like interest subvention and crop insurance, PM Faisal Bima Yojana, a push for modernization and profitability at the ground level.
Minimum support prices, MSPs, for the Kharif season were also hiked.
Yes, increased for 14 Kharif crops for the 2025-26 marketing season. Significant hikes for crops like Niger seed, ragi, cotton, sesame. This follows the policy of setting MSP at least 1.5 times the production cost, aiming to ensure remunerative prices and encourage diversification towards nutri-cereals.
And down in Tripura, an aquapark foundation stone was laid.
Part of the Patan Matri Matsya Sampada Yoshana, PMSY. This aquapark is envisioned as an integrated hub for fisheries, hatcheries, feed mills, cold storage, training, marketing, aiming to boost the fisheries sector, provide livelihoods, especially for youth and women, in a state with high fish consumption.
And a new herbicide launched by Danuka Agritech.
Yes, Dinkar, specifically for controlling weeds in transplanted paddy, developed in partnership with a Japanese company. Another example of new inputs becoming available to farmers.
Okay, looking at this whole segment, Visakhapatnam Port, inland waterways, the massive renewables push, coal policy tweaks, ethanol from rice, mining growth, digital PDS, and all these specific agri-initiatives from gene editing to price support and credit. How do these pieces fit together? What's the bigger picture they paint for India's economy and potentially for your access to resources or opportunities?
I think they strongly signal a focus on strengthening the fundamental supply side of the economy, improving logistics, infrastructure ports, waterways, ensuring energy security while transitioning to cleaner sources, boosting agricultural productivity, and making the food supply chain more efficient and resilient.
Building the foundations for growth.
Exactly. These are all foundational elements needed for sustained economic expansion and also for managing things like inflation over the long run. For individuals, this could translate into, more reliable and maybe eventually cheaper transport and energy, better food availability, and certainly new job and investment opportunities in these developing sectors like logistics, renewables, and agritech.
It's clear how interconnected these developments are.
Deeply. Infrastructure needs steel and cement from mining, which requires energy. Agriculture needs inputs, finance, and efficient distribution. All rely on the financial system we discussed earlier, operating within that broader economic policy framework.
Which neatly brings us to our final section, some broader economic and social support updates from May.
All right. A key one was the revision of the Credit Guarantee Scheme for Startups, CGSS.
They increased the guarantee cover significantly.
Doubled it, actually,
Yeah.
from a maximum of 10 crore to 20 crore per borrower.
And this scheme helps startups get loans without collateral.
Exactly. The government guarantees a large portion of the loan amount, up to 85% for smaller loans, 75% for larger ones, made by banks, NBFCs, or even AIFs. By doubling the cap, they're making it less risky for lenders to provide larger amounts of debt funding to startups.
Encouraging more funding for innovation and R&D.
That's the goal. They also reduce the annual guarantee fee for startups in certain priority sectors. It aligns with the government's push to support the startup ecosystem, particularly for early-stage credit needs.
The Finance Ministry also put out a draft climate taxonomy document. What exactly is that?
It's basically a classification system, a framework designed to define and categorize which economic activities and investments can be considered green or climate-aligned within the Indian context.
Why create this taxonomy?
The main goal is to guide capital flow, to help investors, companies, and financial institutions identify projects and activities that genuinely contribute to India's climate goals, like reaching net zero by 2070.
So preventing greenwashing and channeling funds effectively.
Precisely. It aims to bring clarity, ensure credibility, and mobilize the significant private investment needed for climate mitigation, like clean energy, and adaptation, like climate-resilient infrastructure. It distinguishes between climate-supportive activities and climate transition activities in harder-to-abate sectors like steel or cement.
A foundational piece for India's green finance landscape.
Definitely. And speaking of foundations, a major milestone was reached by the Jan Suraksha Social Security schemes.
10 years old, right? PMJJBY life insurance, PMSBY accident insurance, and APY pension scheme.
Launched back in May 2015, their objective was to provide very affordable Social Security coverage to the masses, especially the poor and vulnerable sections of society.
And the scale they've reached is incredible.
It really is. Hundreds of millions enrolled across the three schemes. PMJJBY has over 23 crore people, PMSBY over 50 crore, APY over 7 crore. And they've disbursed significant amounts in claims, providing a crucial safety net for many families.
Leveraging bank accounts and digitization.
Yes, using the Jan Dhan bank account network and digital platforms like the Jan Suraksha portal made enrollment and claim processing much more efficient. It really demonstrates the power of using technology for large-scale financial inclusion and social protection. Securing the unsecured was the motto.
A significant achievement over the decade.
Undeniably.
On a related note for savers, the government ratified the EPF interest rate for FY25.
Yes, confirmed at 8.25%. This applies to the employees' Provident Fund deposits for over 7 crore subscribers.
Same rate as the previous year.
Unchanged. The EPFO board recommended it earlier in the year, and the Finance Ministry's concurrence means the interest can now be formally credited to subscriber accounts. Provides certainty for retirement savings.
Looking at infrastructure investment again, Crisil had a projection about airport capex.
Interesting forecast there. They expect capital expenditure at small private airports to jump significantly, maybe 50–60%, by FY28.
Why the surge at smaller airports?
Because many of them are now hitting capacity limits after seeing very rapid passenger growth in recent years. They simply need to expand terminals and other facilities to cope.
While spending at larger airports might decline.
Yes. Crises expects overall private airport capex to dip slightly because many large airports have recently completed or are nearing the end of major expansion phases. So the investment focus is shifting towards the smaller ones needing upgrades. The stable regulatory tariff framework helps manage the risks for these smaller airports.
And finally, the Department of Economic Affairs amended some securities contracts rules.
A technical but potentially helpful change. They amended Rule 8 of the SCR rules from 1957. The stated objective was to improve the ease of doing business for stockbrokers by updating some outdated provisions, trying to balance necessary safeguards with operational flexibility in today's market.
Okay, let's wrap up this final section. We've touched on boosting startup funding, defining climate finance, celebrating Social Security milestones, confirming EPF rates, shifting airport investments, and simplifying broker rules. Even looping back to that potential U.S. remittance tax. How did these diverse threads from high-tech startups to basic Social Security come together? What does this complex web tell us about the direction of India's economy and society?
It really underscores a multifaceted approach. There's a clear push for innovation and future-oriented sectors, seen in the startup support and climate taxonomy. Simultaneously, there's a continued strengthening of the foundational social safety net through schemes like Jan Suraksha and EPF.
And refining the operational aspects?
Yes, updating regulations, investing where capacity is needed like smaller airports. It's just a strategy that's trying to build capability at multiple levels, fostering high-growth areas, ensuring basic security and resilience for citizens, making the financial plumbing work better, and navigating its place in the global economy. It's a picture of actively shaping development on many fronts at once.
Wow, okay. We have certainly covered a huge amount of ground in this deep dive.
We really have. From the nitty-gritty of financial market instruments and rules, from SEBI and RBI,
To the big economic picture, growth, inflation, trade, the credit rating.
then drilling down into major shifts in infrastructure like ports and waterways, the massive energy transition, and all the activity in agriculture.
And finally, touching on those broader support systems, from startups to Social Security.
It's undeniable the pace of change is rapid, across so many areas, affecting how money is invested and regulated, how we pay for things digitally, how goods get from A to B, even the food we grow, and the safety nets available.
And none of these are happening in isolation, are they? They're all interconnected, shaping India's overall economic landscape.
Absolutely. The threads run through everything.
So, as you, our listeners, reflect on everything we've tried to unpack here, the record bank profits alongside new risk rules, the drive for transparency, the growth numbers versus FDI nuances, the huge push in renewables and infrastructure, the innovations in farming, the digital layer over everything. Here's maybe a final thought to consider.
How might the combined effect of all these diverse developments, especially this relentless push towards digitization, regulatory adaptation, and trying to align finance with broader goals like climate action, how might all that reshape the specific opportunities and perhaps the challenges that you face in your own financial life, your career, or just navigating the Indian economy in the years ahead?